All right, so first things first, I actually created this presentation sometime back, and I think it's a very valuable one for different types of MI options for purchase loans. So I think we're going to go through this one today. So what I've done here is I actually created a marketing report, and in order to do this, you can simply toggle between individual and marketing. And the distinction between these two is that when you're doing an individual report, it keeps the first and last name of the borrower on the report, and it also keeps the property address on the report that appears in this contact information area. When you choose marketing, it actually strips those off. So you won't see a first and last name, you won't see a property address, but you will have an area here where you can put a report headline rather than a first and last name. So that's what I've done here. I've called this one Keep MI in Your Pocket. And this is going to be just showing the MI options. Now, it's important to note that you have an area here now to enter a partner email. Now, the reason this is here is because on the new client side, you don't have an area where you can co-brand these presentations. You can only co-brand on the new partner side. Those are just the open house flyer and the seller buy-down strategy. However, when you want to have an alert issued to your partner on one of these client reports, what you do is you enter your partner's email in here, and then when you get to the end of the presentation, there'll be a checkbox to notify that partner when the report is viewed. So make sure to always enter a partner email in here. It's the easiest way to keep your realtor partners in the loop, or especially when you're doing marketing proposals like this. If you're posting it on your website, you may not want a partner involved on it, but if you're posting it or allowing the partner to post on their website, you want them to get notified every time this is viewed so they can see what kind of traction it's getting. So I've entered a partner email address here. And I'm going to choose the purchase goal. And when you get to the goals screen, there's a lot of goals in here, and eventually there will be logic tied to each one of these checkboxes. Right now, the only one that really determines the workflow inside Edge is the purchase a new home goal. When you choose this one, it eliminates the need for a current mortgage. So you may have found that when you're doing purchases, if you don't check this box, you still get asked for that current mortgage, and it'll show up on the presentation unless you choose to uncheck it when you get to the presentation screen down here. But to avoid that, simply just check the box here, and it won't even ask you for it. Now, current property value, this is going to be your purchase price. So I've entered my purchase price of $250 in here. You notice that this is the only field in red, so it's the only one that's really required. And I would tell you, even this one's not even really required. It's just going to make your life a little bit easier when you get into the products section, because it'll automatically funnel that purchase price in for the purchase price on your new products. Now, when we get to our affordability section, now, for a marketing report like this, you're probably not going to have specific information for your borrower. So oftentimes, you can leave this one blank on a marketing report. Now, in this case, what I've done is I actually entered a savings balance in here and a savings rate of return. And the reason I did this is because I've already done the report, and I know that if I go to my adjust reinvestment strategy, the cash to close for all the different loan options that I'm showing them is just under $17,000. So I put 17 in there to make sure that there's enough cash in that savings account to pay off the cash to close. And what that does is it automatically subtracts the cash to close and leaves them with a new adjusted savings start. Now, you can use any figure you'd want for that savings balance. I mean, you may want to assume they got at least 25 in the bank, and that's fine. But what it's going to do is it shows that new adjusted savings balance, and it shows continued growth going forward. And you can see at the 15-year point what these turn into. They're not growing tremendously, but this is a great way to show differences in down payment options too. So for instance, if you know your borrower has 20 grand and there's a couple of different options depending on LTV, there might be one that only requires them to bring in a couple of $1,000s versus another one that requires them to bring in 15 or so. Now in that case, the difference between those two will show up here in the adjusted savings start. So you'll see that as those grow over time, you can make the comparison for bigger down payment versus lesser loan amount. So it'll give you just an additional area where you can forecast some long-term growth for what their assets are. Again, since it's a marketing report, not terribly necessary. I like to have it there just so I have some positive numbers in this field, but certainly not necessary for every one of them. So getting back to our assumptions area. Now the last part here is the tax bracket. Now if you do want to show the tax benefit on any of your total cost analysis presentations, you got to make sure to enter a tax bracket here. If you don't want that tax benefit to show up, just leave this field blank. It won't show the tax benefit at all. Now it's important to remember too that anytime you are showing a tax benefit, you want to make sure that your disclaimers reflect, some verbiage indicating that you're not a tax advisor. They should consult their CPA for this. or this is simply an example presentation, that kind of thing. The key to the Mortgage Coach presentation is that it's an educational tool, and it's meant to be delivered pre-GFE. Now, oftentimes you may deliver this post-GFE. However, it's meant to basically give them enough information to make that educated decision before they've made a commitment on a GFE. So for this presentation, I'm going to go ahead and leave the tax bracket area blank so we don't have any tax benefit going forward. Now, for those of you who like to use the tax benefit feature, if you'd like to know how that's calculated, shoot us a quick note over at support@mortgagecoach.com. We'll give you the exact equation for it. But basically what it boils down to is it takes your interest, it takes your property taxes, and it takes your MI if you choose to include that, and it makes those tax deductible. So it'll multiply those times the tax bracket to give the tax benefit. And the tax benefit is represented through both the monthly area, and then you'll see it in the short-term area as well. In the monthly area, it's specifically just the first month's tax benefit. When you get to the short-term area, it's a cumulative total. So all of the property tax they've paid, plus all of the interest they've paid over that time, plus all the MI they've paid, multiplied by their tax bracket. But again, if you want that in writing, we're happy to send that over to you. So affordability section, second page here, you don't need to fill this in. You're not actually taking an app for somebody. This is a marketing report, so we can leave these ones blank. And then I'm going to show a few options against each other. And if you look on the right here, you can see that I've already prepared these. And what I've done is I've shown an FHA loan, and then I've showed a couple of conventional loans that are 95%. And I've showed a couple of different options on what they can do with the MI. So naturally for the FHA loan, if you're brand new to this software and you're just doing your first loans in here, anytime you're doing an FHA, there's a couple of factors that you need to make sure are present. One is you got to check the radio button here that says, yes, this is an FHA program. Now what this does is when you check it, the next screen opens up a field where you can enter the upfront MIP, and you can finance it into the loan. So let me go back one screen here. So I've checked the yes radio button. And for my FHA, I can actually do a 3.5% if I want to as well. It's up to you if you want to do varying down payment options. For the sake of making these even across the board for the down payment, I've made this a 5% down FHA. Now I put in my interest rate and my term, and remember the term is always in months, so if you ever find that you have a super inflated looking payment on your presentation, you've probably entered these in years, so you put 30 years instead of 360 months. That's the number one thing that you should look for if you've got a really wacky payment. Now, as I said, I've already input the upfront MIP, and I did it as a percentage, so I just used the 1.75, and then I checked the box to add the upfront MI to the loan amount. Now, you can see that my closing costs are grayed out here, and the reason they're grayed out is because I've actually populated my closing costs using the detail screen here. Now, if I want to make any edits to these, I need to come back into this detail and edit the specific fields that I want, because I won't be able to type over those gray fields on the outside. So for instance, you can see I've only got a few fees in here. I'm probably going to need quite a few more. If I was to really look at one of my past fee worksheets, that's probably the easiest way to figure out what fees need to get in here. Additionally, if you want to, if you don't have an itemized breakdown of your fees and you can't pull a fee worksheet for some reason, you can always, if you want to, use the ballpark fees. So if you wanted to be able to edit these rather than using the detail, simply delete all your fees here, apply to loan, and you can see it opens up these fields so you can do just ballpark amounts. So for instance, I want $2,500 in APR fees. Prepaid escrows, I'm probably going to have about $1,000. Non-APR costs, maybe $1,500. And if there was any contributions, you could put those in as well, say a seller or a lender contribution on this. For this one, I'm not going to indicate any contributions because I'm actually, on some of these other ones, I'm going to use contributions to help finance in that MI. So the last part here is putting your monthly hazard taxes, and I like putting those in as factor percentages, but feel free to use whatever you'd like there. And then mortgage insurance, very important. You want to refer to your FHA guidelines to make sure that you're using the right figures, but this is a high LTV FHA loan, so this one's going to be a 1.35 factor. And then the most important part, there's two things here that you got to do this for every FHA loan. This doesn't apply to conventional. Is you want to check the box to recalculate the MI based on the average balance over 12 months. Your loan origination software does this already anytime you select an FHA loan. So you got to make sure you check this box, and it'll ensure that your monthly mortgage insurance comes out correct here. it's also going to show a declining MI over time. So every year, that mortgage insurance payment is going to be reducing based on the average of their last 12 months balance. Now, very critical as well for FHA loans that are over 90%, these have to go for the life of the loan. So you want to make sure your MI cutoff month is at 360. The percentage doesn't even matter at that point anymore because Edge is going to carry that MI for the life of the loan. Now, if you do want to make this tax deductible and you've entered a tax bracket, you would check the box here to make that MI tax deductible. Now, with this one, I'm showing a conventional 5% down, and this is just a standard loan with monthly MI. So I've entered, no, it's not an FHA loan. I've got my 5% down. I'm showing the rate that I can get on a conventional loan right now. I've applied my closing costs, and notice I've got no contributions on this one either. And then I've got my hazard and taxes, but I've got my conventional MI here, and it's going to be a little bit less than what FHA can provide. You'll want to check with your particular MI provider to find out exactly what factor you would use for a 5% down conventional, but it usually ranges anywhere between 0.9 and 1.2. Now, for conventionals, you never want to check this box. You don't want that MI recalculating on the average balance every 12 months because mortgage insurance on a conventional loan does not decline. It cuts off at 78%, but it does not decline over time. So the factors that we need to make sure are plugged in here are 78%. That's really the key factor. You want MI to cut off at 78. Now, I've put 24 in here because you may find if you read your MI guidelines for some conventional loans, they still require the MI to carry for at least 24 months. Since this one is a high LTV loan, getting to 78% is going to take me some 70 or 80 months anyway. So I'm not terribly worried about it on this particular one. But if I was pretty close, let's say, for instance, my LTV was 82 or 83%, my MI is going to cut off pretty soon at that 78% mark, and it actually may be short of the 24-month requirement. So when I do conventional loans, basically I just do them both at all times. I'll show the 78 and the 24. But again, when you're doing high LTV, that 24 is not even going to come into play. Now, the third option I'm showing them is lender paid MI. You know, what I've done for this is I've just called it LPMI here, but I've boosted the rate. And you saw on the previous one, I was showing a rate of 4.5. Now, on this one, I'm showing a rate of 5.5. So as the lender, I'm going to be giving a concession back to cover that MI. So I've built it into my rate here. And the easy part about this is you don't even really have to do that contribution in the closing cost detail. All you have to do is don't enter MI when you get to your monthly escrows field. So your start rate has incorporated the MI in it. Now, the last option I'm showing here is a single MI premium buyout. Now, there's a couple of ways you can do this. On a 5% down conventional loan, if you can do a single premium buyout, usually you're still limited to 97% total LTV. So if you want to do a buyout, you can enter the buyout right here in this upfront MIP field. But remember, don't exceed your guidelines. So if your buyout's actually 2.25, which it usually is on these, you'd want to put 2% right here, roll that into the loan, and then you've got your 97% LTV, but you still need to account for that other 0.25%. So you would go into your closing cost detail, you would add a custom fee, call it something like MI buyout, make it an APR fee, and then hit OK. And then what you're going to do is just put in your 0.25 there. And you can see that this is now going to be called for at close. It can't be rolled into the loan because it exceeds the guideline. So I'm going to ask my borrower to bring this in at close. But by doing this, by financing in that upfront MIP, at least part of it, and then paying the rest of it right here, they don't have to have monthly MI anymore. So you want to consult your guidelines to make sure you understand how these programs work. But this is a very effective program. When you can buy a client out of MI and they don't have to pay that for 100 months or however long it's going to last, it's a significant savings. And you'll see it over the long-term interest in MI when we look at our analysis screen. So I'm going to go ahead and apply that to the loan. And you can see when I get to my monthly escrows, I don't need to put anything in for the monthly mortgage insurance. I've successfully bought them out of that. Now let's check out what we've got. Now on our analysis screen, you can see obviously the FHA is going to be the one with the highest payment. Monthly MI is going to be a little bit lower because we've got a lesser MI factor for this conventional loan. Lender paid MI, significantly lower because they just don't have MI at all. But we've boosted their rate a little bit, so that's the difference between the single MI premium and the lender paid MI. With a single premium, they're not responsible for MI at all, and they get the lower rate. So it's going to save them a good chunk of money per month. Now, it's up to you in terms of what you want to do with these monthly savings. And I would always recommend you do something with them, whether you're putting it straight back into the mortgage as a principal reduction payment or applying it to their savings account to show them how they can gain wealth by just putting this money away every month. Now, to do that, you're going to go into the Adjust Reinvestment Strategy button. Now, in the Adjust Reinvestment Strategy button, you have the option at the top here to do principal reduction payments. In the middle section, you can do payments back to their current savings. And in the bottom section, you can do payments to a new investment vehicle. So instead of their savings, which has a really low yield, we might want to recommend that they put this back into this new vehicle. So if I'm going to do that, I'm going to put my 105.44 here. I will put my 226.49. And then if you want to, you can see right here, I've actually customized this one. You can see that this conventional with monthly MI, the MI cuts off at month 112. So I know that up until month 12, I have a $58 savings. But after that point, I don't have MI anymore. So I'm going to have a significant amount of money, more money that I can attribute to that investment account. Now, in order to customize these guys, double-click on any of these items here. These ones with a blue border around them. If you double-click on them, it's going to bring up a little table that shows you exactly what you can do with this. So initially, I have $58.58 that I can reinvest. So starting at month 1, I'm going to have that money going straight into that investment account. Now, my MI cutoff is month 112. So at month 113, I want this MI payment of $191.98 plus the $58.58. Let me break open my calculator real quick to find out exactly what that is. And that comes out to $250.56. So I'm going to put that in here. Now, what this is indicating is that from months 1 to month 112, there's going to be $58.58 going into their investment account. At month 113, it starts doing a $250 payment, and this is going to continue for the life of the loan. So what we're showing here is we're showing an apples-to-apples look at cash flow between all of these different products. So I'm going to hit OK on there. And you can see what we've got. At the 15-year point, we've got a significant amount in this new investment vehicle. And obviously, their original savings account with a low yield like that, it's not producing very much. But this presentation is great for use with financial planners. So if I wanted to send this out as a marketing presentation to my borrowers, I might want to copy my financial planner as that partner email so he can see what's going on. And the whole idea behind this is we're showing different ways that they can use that same amount of money to either gain wealth over time, or if you're using term reduction payments instead, you just do the same thing up here and leave these bottom areas blank, in which case you'd see shorter freedom points on each one of these, and in fact, a shorter MI cutoff on this conventional loan because you're paying principal down faster. Now, once you're done with that reinvestment, there's really not much left to do over here in the analysis screen, but you have options on how you want to show this. So for instance, if I know my monthly MI is going to cut off at month 112, I might want to show my short-term analysis months at maybe, I don't know, 120. So I'll show a 10-year period there. And you can see obviously the single premium is saving them the most money over time. And let me clarify real quick for those of you who are brand new to presenting this type of report. The short-term interest savings, this is not just the monthly savings multiplied by whatever figure you have here. It's quite different, in fact. What this is this compares the total interest, MI, and closing costs between each one of these programs. And it gives a total cost that are based on those figures. Now, the difference between those total costs is what you're seeing right here. So basically what we're looking at, and if you're asked to explain this, and if you want a good piece of verbiage to use around this, is this area isolates just the unrecoverable costs on the loan. Now, these costs are interest, MI, and your closing costs. And we don't include things like the prepaids in here. So prepaid escrows, they're going to pay those either way. So we don't include those as a cost of doing the loan, which means that We're just isolating the parts they can't get back. Now, long-term section, you have choices on which options you'd like to show. Principal paid, you can see that there's a pretty big difference between these. The FHA actually pays the most principal over time, but it depends on your conversation with the borrower in terms of where do you want to be in 20 years. And again, we'll change our long-term years to reflect that. You know, where do you want to be in 20 years? Do you want to have more equity in your house, or are we looking for the least amount of interest paid, in which case, or actually interest in MI, in which case that single premium one wins out? Or are we looking for net worth? Now, the net worth is a combination of their total equity plus the liquid assets that you've developed using this reinvestment strategy. So if you're going to show a reinvestment strategy, I highly suggest you show net worth. And you can see that my single MI premium has the highest net worth here because it's paid a good amount of equity, but it's also developed a pretty good liquid asset over this time period. Now, for this contact information area, because we made this a marketing report, you don't have to fill this in. You can leave it completely blank. And the last part is just choosing which options you want to show on the report. So I'll usually show them all unless somebody comes back and says, you know what, I don't even want to bother looking at the FHA loan. Let's just look at the other options. In which case, you can always come back to the screen and uncheck the one that you don't want to show. And as soon as you hit one of these arrows, whether it's the right or left arrow, it'll automatically save your changes and update the live report for you. Now, I will tell you that I'm starting to see a lot of reports come across my desk that don't have payment notes on them. Payment notes are incredibly important for compliance. This is just the simplest way to cover yourself. So, for instance, if in this particular case, I am including taxes and insurance, and in fact mortgage insurance, I'd probably want to add that. But I want to show exactly what's included in that pity payment. And the reason for it is we need something that indicates this in close proximity to the payment. When you enter something here, it automatically puts a double asterisk, just like this, right next to your monthly payment, and then it puts one next to this text as well that appears very close to it. So make sure you've always got these in there. It's just going to help. It's an extra disclaimer that covers you. Now, as we continue through the screens, we get additional areas where we can add more verbiage. If we wanted to add a little bit of color around what these are, these appear in the More Info sections on your live report. So feel free to edit this text if you see fit. Short-term area, again, remember this one is one of the ones that this is where your advice comes out as an originator. You're not just comparing monthly payments over time. You're comparing the real costs of the loan over time. So you might want to put in a little bit of extra verbiage in here to explain what this is actually comparing. So in my case, I would put in something like this section, and horrible typist, so sorry guys, compares the unrecoverable costs over time for each loan. These costs include interest, MI, and closing costs. Something like that, so that then when they hit the more info on this graph, they'll be able to see exactly what this is talking about. Long-term section, because I chose net worth, I might actually want to put a little bit of verbiage in here that talks about what this is. Something like that. And then the last part, I need to present this report. So I will tell you that the best way to preview this report is first hit Generate Link. And I'm telling you this because the Generate Link button is what saves your report to history. This is going to ensure that all the data that you have on your screen has been saved to our database correctly. And when you want to actually preview what the report looks like, click on Edge Live. This is just like hitting the preview button in the other screen, but you've already got the link now, so now you can send the link out, and whatever you generate from this, for instance, on Edge Live, you can do all the highlighting. So whatever I want to highlight here, I can leave it highlighted, or I can clear all the highlights if I want. But remember that whatever state you leave this report in, when you close it, is what the borrower is going to see when they open it. So if I'm specifically wanting to draw my borrower's attention towards the MI, I'm probably going to hit the More Info button here. And then I'm going to go into the payment breakdown, and I'm going to highlight the MI for each one. Now, if I was to go up and just hit the X right now, and then send my borrower this link, watch what happens. I'm actually just going to paste this link into my browser bar, hit enter, and when the report opens, you'll see that the More Info section has already popped out, and the areas I highlighted are still highlighted. Now, if you have a video attached to this, the video would actually play underneath this More Info section that popped out. So they'll hear the video. They may not be able to see it because it'll be underneath this screen. But if this is the case and you're going to leave the report like this when you send it out to your client, make sure to let them know during the video, verbally, that they can hit the X on this detail screen to get back to the main presentation. And they'll see your smiling face talking to them right there. And then you can guide them through the rest of the report. Now, it's very important when you're doing your videos for the clients that you don't necessarily have to explain every item on the video. What you're looking to do is you're looking to keep it to about 2 minutes. And you just want to touch on the top level points. You know, I've got 4 different options for MI here. Explain what each one of them talks about, but do it very briefly. And then let your client know that they can click on the More Info sections in each one of the quadrants to get the full detail. Things like, you know, the full breakdown on the pity payment. It's under the More Info section here at the top left. If they wanted to check out their closing costs, they can hit the fee details sections here and see exactly which fees are part of this. And in fact, if I was isolating this particular report as something based on closing costs, for instance, I wanted to show them the difference between a lender credit versus no lender credit, I might actually want to pop out the fee detail, highlight the item that I'm talking about, then close the presentation so that when it opens up for the client, this is the first thing that they see. But again, if you're going to do this, make sure that your video indicates that they can close out of this part so they can get to the rest of the presentation. All right, so I don't see any questions coming through yet, so hopefully you guys are just all in awe of this awesome presentation that we put together. Feel free to use this. This call is being recorded, so even though we're on a different call today, I am recording it. I will post it up to our coaching call archive so you guys can try and recreate this if you need to. And let's see if there's any further questions in here. Okay, nothing yet, so let's do a basic refinance. I know these aren't very hot right now, but there's still a lot of people that are in need of refinance. Maybe they're still in an option arm, or you know, maybe they're in an arm that's about to adjust, and there's, you know, a little bit of fear on what it's going to do. Let's create one of those. So anytime you're doing a purchase or a refinance and you want it aimed at the borrower, always choose new client. If you want it aimed at a partner and you just want one of those flyers, that's when you're going to choose new partner. So for this one, I'll do it as a specific borrower. We'll call this one Joe Borrower. And then if I want my partner copied in, remember I'm going to put the partner email in here. In this case, I don't want the partner copied in, so I'm going to leave that one blank. Now, friendly name, this is one of the most important fields inside Edge, and I'm going to show you why. So friendly name, let's call this refi for second home. The reason this is so important is if I've done multiple presentations for Joe Borrower, the only way I'm going to be able to identify which presentation this is when I'm looking for it inside Edge is with this friendly name. So let me show you what that looks like. If we go to our home screen, and let's say Joe Borrower wasn't the last one that I updated. I did this presentation 2 months ago, let's say. When I go to View All, I can search for Joe Borrower. So I'll hit Joe, and you can see that if I didn't put a friendly name here, this refi for second home would be missing. All it would show is the date and time stamp. So if I've got multiple presentations for this one, say he had multiple properties, I'd want to make sure that each one of these does have a friendly name so I can identify which is which. So let's close out of there. We'll get back into the presentation now. So for a refi, we're just going to choose any of the goals that are not purchase a new home because we do want to be asked for the current mortgage. In that case, let's say lower interest rate. Now there's a couple of fields here that you can feel free to use, but they're not required. But I'm going to explain what they do for you. Now the current monthly mortgage payment, this is simply a data capture point. This is for you to record what your client has told you they're paying for their monthly mortgage payment. Now, when Edge generates the payment that shows under current mortgage on the presentation, it's not going to use this payment. It's going to use the loan balance. It's going to use the original loan amount, the rate, and the term. If it's IO, it'll use the current loan balance to determine what their payment is. So keep in mind, this is just where you're recording what your client has told you they're paying. Current property value, this is very important. We definitely want to have a current property value because the LTV for the current mortgage is dependent on this. So if we don't have a property value, then we won't have an LTV on the current mortgage. Now that said, if their current mortgage has MI, we don't want the MI cutoffs to be based on what the current property value is. It has to be based on the original appraised value. So it'll cut off way too quick if we use what the current property value is if it's higher than what they originally took out. So let's say that when they bought this, it was actually only a $250,000 house. Now, current total payoff amount. What we did is we put this in here to make it a little bit easier for you. Now, the way the cash to close is generated right now in Edge is that it takes your new loan amount and it subtracts the payoff for your current loan amount. Now, if you don't enter anything in this payoff amount field, what Edge uses for the payoff is your remaining balance from this section right here. Now, usually your remaining balance is not exactly the same as what your payoff is going to be. So we let you do both. So let's say that, let's generate what this loan is first. Let's say they took this out a few years back, and their original was for $200,000. Let's say it was actually $225,000, so we have MI. And at that point, they had a 5.5 rate on a 30-year term. Now, if I don't use that payoff amount field back in the previous screen, Edge is going to use this remaining balance for my payoff on the current mortgage. So my new loan amount will pay this off, and any difference between those two will either be cash out or cash to close. Now, that said, if I'm planning to close this after their next payment, my remaining or my payoff amount might actually be lower than this. So it might not be $215, it might be, say, $214. So I'll put my $214 right here. Now the next screen's here. We want to populate their monthly taxes and insurance. And if you know the exact figures, feel free to put them in. And then we want to pop in their mortgage insurance. So let's say back then they had a 0.9 factor. And since this one is a conventional loan, we're just going to have to put the 78% cutoff. We don't need to indicate the months here. And then I'm going to continue on. Now the affordability questions, remember, these are great for when you're doing long-term planning or when you're doing a pre-qual for that matter. You want to find out what their income is, find out what their DTI ratios are going to look like. All this information here is critical for doing the pre-app. If you've already covered all this stuff and you've got this information from the client, you can feel free to skip this area if you need to. There's nothing in red here, so there's nothing that's going to be an absolute requirement for your presentation. Now, same thing here, the second affordability screen, I would say 9 times out of 10 you're going to skip that screen. So feel free to just run right through it. Now, what we're looking at here, and I want to draw your attention to this because this is why the payoff or why the original appraised value field is so important. Our current LTV is 71.7% based on what that current property value is. So it wouldn't apply MI. But the reason I put in my original appraised value at 250 versus 300 is they're still responsible for MI relative to that appraised value, not today's value. Unless they've had a new appraisal done on it and they've applied to get the MI dropped off, it's not accurate. So we got to use the original appraised value here if you do know that. Now, if you don't know it, it's okay. If you find that you know that they have MI and Edge is not showing MI, it's because that LTV is too low, which means you need to go back to that original appraised value and just kind of guess at it. Just guess something that would definitely put them over the 78% mark. All right, so our new refi loans. Now, when we choose a new product here, I mean, obviously we're going to name this one, let's say 30 fixed. When we choose yes for a refi, it automatically brings in the payoff amount as your new base loan amount. Now, remember, my current balance is 215 something. So if I didn't include a payoff amount, it would have pulled that figure in right here. Since I did include a payoff amount, it pulled in the correct one, the 214. Now, interest rate, let's say I can get them 4.5, and this is a 30-year term. And then for my closing costs, remember, you can ballpark these if you want to, or ideally you want to have some templates created so that you can just pull one down. So there's my 30-year fixed refi. And you can see I've already got everything in there. I'd probably need to modify my loan origination a little bit. Let's see, this is probably closer to 2,000. And then for most refis, if you're not bound by any LTV restrictions, you're usually going to end up adding most of these fees to the loan amount. You want them financed on top rather than the borrower having to come in with these fees. So if that's the case, you would just check these boxes to add to loan amount. Now, I will show you one little trick here. If you've also got a contribution and you want the contribution to do the same as these fees, meaning these fees are going to be added to the loan amount, the contribution would reduce the loan amount. If you want to do that, click Add Fee, choose the one called Contribution, and you can do this by clicking a C on your keyboard once you've got this drop-down open, and select Contribution. And let's say that this is a $3,000 lender contribution. Now if I don't check this box right now, this is going to show $3,000 cash out because I've got an even payoff from their base loan amount to their current mortgage, and then I've got all the fees rolled in. So that would be a zero cash to close, except I'm showing $3,000 credit. This right now would show $3,000 cash out. But I want this $3,000 to reduce my total amount financed. I don't want it to come in as cash out. So in order to do that, I'm going to add the contribution to the loan amount. Now this is great for your refi templates because this allows you, if you want to, add everything in and then allow the contribution to reduce that amount financed. So you don't have to do all the math for it. It automatically does it for you. Once you're done, hit Apply to Loan. And then we're good to go there. And you can see when we get to the next screen, we're still going to need to do our monthly escrows here. Oops. And our new LTV is definitely below 78%, so we're not going to need monthly MI on this, so we're definitely going to save them a bunch of money here. So I'm going to add one more product. Now, I get the question coming across my desk a lot, and the question is, what happens if this borrower only qualifies for one product? You know, what if I don't have several products to show them because they just don't qualify for them? They only qualify for that FHA loan. What do I do? You know, how do I get a comparison showing on Edge with only one product? Well, the question is, why don't I have any graphs on my presentation because I only have one product? There's nothing to compare against. So the idea is you never want to just have one product on your presentation. In this case, it's a refi, so I've got current mortgage versus new mortgage. That's perfectly sufficient. But if this was a purchase and they only qualified for one product, I wouldn't have any graphs when I got to my presentation screen because there's just no comparison going on. So in cases like that, there's a couple of things you can do for a secondary product. One, you can show the same product as you just showed, but show it with a reinvestment strategy of some kind. Say, showing it with an additional $50 a month to pay down term reduction. You know, that's the whole Skip the Bagel presentation that you guys have probably seen on our Facebook page. It just shows how they can take, you know, the $50 or $150 a month and reinvest it straight back into their principal every month and cut their freedom point by like 9 or 10 years. It's ridiculous on say, a $250,000 loan. Now, another option that you can do, excuse me, another option that you can do is when you're comparing a single loan, you can do the same loan but with, say, lower costs. So, for instance, if you guys look at the new GFE, there's actually an area in there that shows a spot where you can compare one loan with high cost, one loan with low cost, and you can show different variations of the same loan just depending on where the costs are absorbed. So what I usually recommend is if the person can only qualify for one program, show that same program again, but boost the rate a little bit and show a lender credit that's covering some of the costs that they would have otherwise had to pay. So this would be a low cash to close kind of thing on a purchase. Now on a refi, you could potentially do the same thing if there were costs that you couldn't finance in because you hit an LTV cap and it doesn't conform to the guidelines. You could do something like build in a little bit higher rate and show a lender credit that would allow them to bring in less cash to close. Another option is you can show a shorter term loan. So in this case, I'm going to do the shorter term loan. I'm going to do copy from, and I'm going to copy that 30 fixed I already did. And then I'm just going to rename this 15-year fixed. And all I have to do is change my rate and term here so I can get them a slightly better rate on that 15-year note. And now I've got a comparison. Now, obviously, the 15-year note is going to have a much higher payment because it's got a shorter term, but it certainly could be a viable option for your client. If they're already making additional principal payments on their current mortgage and they can afford that, it might be a good idea to start them into a new 15-year note. Now, because I copied, everything came over for me, so I don't have to do any additional legwork on this refi. Now, here's something I want to draw your attention to. Remember, we noted that the 15-year note has the highest payment. So the reason my current mortgage is showing a savings is because it's $207 less than what my 15-year note is costing them. Now, that said, this is a function of the benchmarks. By default, Edge chooses the highest payment loan and compares the others against it. If you want to change which loan is being used as the benchmark, which oftentimes you will if you're doing a refi, you can change that by using the drop-down button right here and selecting, say, the current mortgage. So now this shows my 30-year fixed is saving them $339, whereas this new 15-year note is costing them $207 more per month. But look at what we get out of the deal. We get a net savings that is gigantic on this 15-year note because they're paying a lot more principal and a lot less interest on that shorter term. And if we look at total interest in MI over time, it gets pretty staggering. There's a pretty marked difference at the 15-year point, which I'd recommend the 15-year point for this because I'm showing a 15-year loan. But you can certainly come in and change this at any time, and it'll automatically change on your borrower's presentation. So you can see the total interest in MI over time. There's no MI on these, but there is on the current. The total interest in MI over time, over a 30-year period, we've got a huge difference. You know, $120,000, $130,000 difference here. Now, the one thing I would probably do on this one is show reinvestment for this cost savings, this $339 savings that we'd be giving them with this new refi. So I'm going to go into my reinvestment strategy grid again, and I'm going to show this as a principal reduction payment. Now, what's good about doing this is if you look at their current mortgage, their freedom point is 26.92 years away. They're still going to have MI for another 62 months on that current mortgage. On the new mortgage, because we've done this extra reinvestment, we've taken this from being a new 30-year note to being paid off in 18.58 years. So rather than restarting them in an amortization schedule that would show a 30-year payoff, because a lot of borrowers are going to look at that and go, well, now I have to pay an extra 3 years on this. Well, no, you don't. I'm saving you enough money every month that even if you didn't put all of it back in, let's say we only put $100 back in. Even if you only put $100 of that savings that I'm showing you, you're still going to pay off your new note faster than you would your current one, and you're not going to have MI for the next 62 months. So pretty good metric here, and feel free to use all of these in conjunction if you'd like. I'm saving them $340. Maybe I only want to put $100 into the principal reduction, but I want to put the other, $100 or $240 into a new investment account. I can put that down here. And you can see it at the 30-year point, I've made them $120,000. Now, 30 years is too far out at this point because we would have paid off all these loans before then. So I'd probably want to set my long-term area to be somewhere around maybe 27, 26 years. So it's just a more accurate figure. Now, the other thing that you can do, and you guys may have noticed this checkbox down here. This checkbox, what it allows you to do is you can use both of these at the same time. Now, currently, this $100 going back into the mortgage every month is going to pay off this new note in 25 years. Now, I'm also contributing quite a bit over to this liquid asset. If I check this box, Edge is going to determine when this one meets that one. So I'm at 25.33 years right now. If I pay off that first lien with my accumulation, once I have enough in there to pay it off, my freedom point now changes to 19.75 years. So at 19.75 years, I will have enough in this investment account to pay off that mortgage, and then it'll continue accumulating. And you can see I've got an extra $30,000 in my account after I'm debt-free on that mortgage. Now, you don't have to use that, obviously. If you don't use it, it's just going to be a liquid asset that keeps growing over time. But if you do want to show them what they could do in terms of paying it off and shaving an additional 6 years off their loan, you can show them that. All right. Now, contact information, this is a personalized borrower report, so you probably do want to put this info in there. You want to have a property address and such. And I'm sure everybody knows this address. And then make sure to put in your payment notes. And then select which options you want to show. Continue on. You might want to update some of the verbiage in here. I generally just stick with the stock ones for the most part, unless you've got something specific you want to explain. Oh, a quick note, you can actually edit what shows up here by default. So for instance, if you want that extra verbiage around the short-term savings to always just appear here so you don't have to edit it every time, you can go into your settings area and go to Report Templates, and under the Total Cost Analysis, this is your short-term sidebar text. So you can put all the verbiage that you want to appear there by default. You can put it in here, and then if you click over to another report or click over to another tab, it's automatically going to save that information in there. So it'll appear as the default text for all reports going forward. Now you can still edit it, so don't worry, it's not going to lock it down for you. But it's a good idea to put whatever you want to say about this as your default so you don't have to constantly edit it every time. All right, so last section of this borrower here. We get past our short and long terms, get to the point we want to generate a link. Always, always, always put a quote date on here. This is also critical because if your client prints out your presentation and it doesn't have a quote date on it, there's no way to tie that rate to a date, and that could be problematic for you. So make sure you've always got a quote date so that the rates shown on your presentation relate to a date on your rate sheet. It's another one of those things, another one of those CYAs, you know. So the last thing here, if you want to be notified when this report is viewed, and most times you do, check the box here and you will be notified via email and through a RateWatch pop-up. And then if you want to use the Call Me Now button, you can hit the Enable Call button, and that will show that little green button on the top and bottom of your presentation that allows the client to click that and immediately call you. All right, Trevor's question, he says, where do I find the rent versus own presentation? All right. So Trevor, we can actually, this one's a refi, so I'm not going to turn this one into a rent versus own, but this MI presentation we did a moment ago, this one is a total cost right now. But if I want to turn this into a rent versus own, all I'm going to do, as soon as this pulls up, there it goes, is I'm going to switch own to rent. Now when you do that, rent versus own automatically becomes a choice when you get to the presentation screen. But anytime you choose rent, you've got to make sure and complete the rent too. So let's go to that section. So let's say their current annual rent or their current monthly rent, $2,000, and annual increase, let's say 2%. Now when we get to our presentation screen, remember this was a total cost 15 seconds ago. Now this is a rent versus own because now I have the option to select rent versus own. I can still go back and select total cost if I want to, and that's perfectly okay. But in order to do rent versus own, you just need to make sure that that first screen indicates rent, and then you'll have the option here in your presentation screen. So at this point, now I'm showing all four of my new products, but they're going to be compared against the rent product as well. So for my payment notes here, let's check and see what it looks like, and we'll determine exactly what we want to put in those payment notes. So I'm going to jump straight over to the presentation. I'm going to put a quote date on there. Oops, wrong ones. There we go. I'm going to generate my link. Now if you want to at this point, you can actually copy this link and send it straight to your borrower, but usually you want to add a video to these, so you would hit add audio video. But I'm just going to preview it right now so that we can see what we need to add in terms of payment notes. So here's the rent versus own presentation, and you can see that it's got a couple of different comparisons. We've still got the total pity payments against each other, just like the total cost had, but we've now got a new area called net monthly payment. Now the net monthly payment, what we do with this is we take this pity payment and we subtract the principal that they've paid. Now if you've also indicated a tax bracket, we subtract the tax benefit from it as well. So your net payment is basically your pity payment minus the principal you've paid and your tax benefit. This is going to be the net unrecoverable cost. Very similar to what we were talking about with this short-term area here where we're just isolating the parts they can't get back. Taxes and insurance, they're going to pay them anyway. Principal, they're going to retain that in the form of equity. So we're not considering that a cost when we're looking at this net monthly payment. Now the interest, obviously, they can get a little bit of a return on that through the tax benefit, but the interest is really what makes the difference between each of these loan programs. So for my payment notes, remember my double asterisk is going to go right here next to the total payment. But because I'm also showing a net payment, I might also want to describe what that is. So when I go back into Edge here, close this part out, and I'm just going to go back to the first screen of the presentation. So I'm going to hover my mouse over this presentation button, and you'll notice there's a lot of areas here in Edge where you can hover over and then select where you want to go. I call these jump buttons, but they allow you to easily get to a specific part of the wizard without having to arrow through it constantly. Presentation screen is one of those screens. So I'll go back to the select report area, and I'm changing it to a total cost for a second just so I can copy this text. So I'm going to copy that, go back to my rent versus own, paste the text in there, but then I also want to indicate what those net monthly payments are. Now I haven't included a tax bracket on my presentation, so it's not subtracting the tax benefit yet. But anytime you're doing a rent versus own, it really is a good idea to include that. So I'm going to go back to my affordability section here, and I'm going to indicate a tax bracket. Now if you don't know your borrower's tax bracket, you can find this very easily by hitting Find Tax Bracket, and it'll take you to the IRS site. You put in a couple of factors, and it'll tell you exactly where they fall in. Let's say they're at the 25% bracket. Now by doing that, we'll wait for the report to update, but you'll see that this principal paid item, there's going to be another line item just beneath it for the tax benefit. And our net monthly payments are going to change as a result of that. There it goes. So now we've got pity payment, the $1,729, minus the monthly tax benefit, $288, minus the principal that they've paid in that month. That gives them a net monthly payment of $1,128. Now the reason we do it this way is because the rent doesn't have any parts that are recoverable. Every time you're paying rent, you're just throwing it away. There's nothing you're getting back on it. You may get a renter's credit if your state actually allows for that, but I got to tell you, I rent in California where there is a renter's credit, and I'm still not eligible. So most times there really is no benefit whatsoever for renting, but there's plenty of benefit on the homeownership side. They're building equity in the form of this principal that they're paying, and they've got a tax benefit relative to the interest and MI that they're paying for this loan. So we show those against each other. What does it really cost you to rent? Well, it really costs you $2,000 a month. What does it really cost you to own? You're going to pay out $1,787, but you're going to get a lot of that back. The net cost is going to be only $1,175. Now you have a couple of different options that you can show for this short-term area. So I'm going to go back to our analysis screen. Now for the short-term area, right now I'm showing rent versus principal paid. You know, how much are you going to throw away on rent versus how much are you going to keep in the form of equity from the principal that you're paying on these new mortgages. Now there's also rent versus tax benefit. Now in this case, and I think I hadn't had the tax benefit or tax bracket in here when I first put this in, but there's also a tax benefit analysis, and again, same thing. I'd probably just need to go through the screens again because I switched this from a total cost to a rent versus own. But let's see what happens here. Let's go with rent versus tax benefit. All right, there we go. So rent versus tax benefit, you can see it populated on the final screen here. It didn't populate inside Edge because I had changed it in the middle of the presentation, but it is here. So you can see total rent paid over this 60-month period of time, $125,000. Total tax benefit for each one of these programs over the 60 months, you know, they're getting back, you know, $16,000 in benefit from just the taxes. Now, long-term metric, rent versus interest paid, pretty straightforward. How much are you going to throw away on rent? How much are you going to throw away on interest? And I'm sorry, this should have been principal. But when you look into this, remember, always want to drive them into the more info sections so that they can see what these values are over time. You know, how much principal are you going to pay over time versus a big gnarly zilch on the rent side? You're not gaining anything by renting. So pretty powerful presentation, very simple, and it's a great way to get borrowers off the fence. I mean, especially when in this presentation, it's pretty detailed. We're showing the rent versus 4 different potential MI options for very high LTV loans. And all of them still net a payment that's just so far less than what they're really paying on this rent. All right, so hopefully, Trevor, that answers your question on rent versus own. The short answer to that is anytime you want to rent versus own, just select rent here in the first screen, and then when you get to your presentation screen, you will have an option to choose the rent versus own, and it'll ask you the rent versus own questions as you go through the wizard. And then if you wanted to change it over to a total cost, even though you've chosen rent, you can still select the total cost when you get here. It's just going to default you to the rent versus own. So if you wanted to reselect total cost and do that again, you could click on total cost, proceed through these prompts here, generate a new link, and your link to the rent versus own will be different to the in reference to the link of the total cost. So let me show you that real quick. So I'm going to go over and generate my rent versus own link. So I can send the client both of these. All right, so when I've selected rent versus own and I hit generate link, it's going to give me one link that I can use, and this is a rent versus own. So I will paste this into a new tab so you guys can see what this looks like. And then if I want to go back and also generate a total cost, all I'm going to do is use the jump buttons here to go back and select report. And then I'm going to select total cost, continue through these screens, and get to the point where I generate a link, and it's going to be a totally different link. So I'll hit generate link here. And now when I take this link and I'll paste it into a new tab, now I've got one rent versus own and one total cost, both developed out of the exact same presentation, the exact same figures. I've just got different links, so I can remember I left this up so I could show my borrower what the MI looks like between each one. But I can also send him the rent versus own link, and when I do that, he's going to see this presentation instead. All right, so it looks like we're about out of time here. Thank you, guys. I know that it was a bit of a pain this morning with GoToMeeting messing up on us, and we had to jump over to this new call. But I do appreciate you guys showing up today. We will be returning to our regular link, so you'll get the reminders and everything for the week after Thanksgiving. So 12/5, we'll be doing our regular Thursday training session as normal, and you can use your regular links at that point. But again, thanks for attending, guys. If you have any further questions, send a quick note over to support@mortgagecoach.com. We're always happy to help.